The decade, known as the Roaring Twenties, was a period of exuberant economic and social growth within the United States. However, the era came to a dramatic and abrupt end in October 1929 when the stock market crashed, paving the way into America's Great Depression of the 1930s. Hello, and welcome back to our channel. If you enjoyed today's video, please make sure to subscribe. It only takes a second, and you can always change your mind later. Let's get to the story. On the 29th of October 1929, Black Tuesday hit Wall Street as investors traded some 16 million shares on the New York Stock Exchange in a single day. Billions of dollars were lost, wiping out thousands of investors. In the aftermath of Black Tuesday, America and the rest of the industrialized world spiraled downwards into the Great Depression, the deepest and longest-lasting economic downturn in the history of Western industrialized world up to that time. During the 1920s, the United States stock market underwent rapid expansion, reaching its peak in August 1929 after a period of wild speculation during the Roaring Twenties. By then, production had already declined, and unemployment had risen, leaving stocks in great excess of their real value. Despite the stock market falling abruptly in late October, the crash was caused by several factors that arose throughout the decade. So, how did the Wall Street crash happen? Overconfidence in the booming economy contributed to the Wall Street crash. Following the bloodbath of World War I, the Roaring Twenties was a period of great economic prosperity. Many Americans enjoyed a new, wealthy lifestyle and were confident that the good times were there to stay. This included spending their wages on new products, leading to a dramatic rise in consumerism. Developments in technology sparked the production of new goods, such as automobiles and household appliances, which advertisers portrayed as essential purchases for the middle class. In turn, this optimism continued to shadow underlying weaknesses in the economic system. New consumer goods were simple to acquire through easy credit, another key reason for the crash. Easy credit allowed Americans to pay for products in credit installments, as well as effortlessly take out loans to fund their purchases. While general debt in America was viewed negatively, easy credit became glamorized as a means of immediately indulging in the growing consumer society. This meant businesses were often not making their full profits instantly. Since many Americans believed the economy would continue to boom, they did not worry about potential issues with future repayment. Before the crash, which wiped out both corporate and individual wealth, the stock market peaked on September 3, 1929, with the Dow at 381.17. The ultimate bottom was reached on July 8, 1932, where the Dow stood at 41.22. From peak to trough, the Dow experienced a staggering loss of 89.2%. Although the price of many large blue-chip stocks declined, smaller companies suffered even more, forcing companies to declare bankruptcy. Many speculative stocks were delisted from stock exchanges. People were not buying stocks on fundamentals. They were buying in anticipation of rising share prices. Rising share prices brought more people into the markets, convinced that it was easy money. In mid-1929, the economy stumbled due to excess production in many industries, creating an oversupply. Essentially, companies could acquire money cheaply due to high share prices and invest in their own production with the requisite optimism. This overproduction eventually led to oversupply in many areas of the market, such as farm crops, steel and iron. Companies were forced to dump their products at a loss, and share prices began to falter. When the market crashed in 1929, banks issued margin calls. Due to the massive number of shares bought on margin by the general public and the lack of cash on the sidelines, entire portfolios were liquidated. As a result, the stock market spiraled downwards. Many investors were wiped out, and the Federal Deposit Insurance Corporation, which guarantees depositors' funds, didn't exist back then. Many Americans began withdrawing their cash from banks, while the banks, which made too many bad loans, were left with significant losses. The stock market crash and the ensuing Great Depression directly impacted nearly every segment of society and altered an entire generation's perspective and relationship to the financial markets. In a sense, the time frame after the market crash was a total reversal of the attitude of the Roaring Twenties, which had been a time of great optimism, higher consumer spending, and economic growth. And that was the story of Wall Street's crash. If you enjoyed today's video, do be sure to support our channel, like, subscribe, and hit the notification bell to stay up to date with our latest uploads. Thank you for watching, and I'll see you all in the next one.